You turn on the news, and it's all about the adrenaline of the stock market or the latest wild swing in Bitcoin. But behind those flashing red and green numbers sits a quiet force, a market so massive that it exerts control over them both. It's called the bond market. This is the foundational plumbing of the entire global financial system. Without understanding how this specific market operates, you can't really comprehend why stock portfolios suddenly crash, or how the modern world funds its survival. Governments typically spend far more money than they actually collect in taxes. That gap between spending and revenue is known as a budget deficit. When you add up those yearly deficits, you get the national debt. Right now, the UK owes roughly $2.7 trillion. The US debt is even more staggering, sitting at $36.7 trillion. To cover that shortfall, governments have to borrow cash directly from the public, from banks, and from foreign nations. They do this by issuing bonds. Sovereign debt functions as an active mechanism, constantly vacuuming up capital from the global system to keep national budgets afloat. At its simplest level, a bond is a loan. The investor acts as the lender, and the government is the borrower. Every bond agreement has three fixed elements. The principal is the amount being borrowed, the maturity is the timeline for when the loan is due, and the coupon is the interest percentage paid to the lender. That coupon is the most critical part to remember. It is a fixed, unchanging percentage of interest that gets paid to the investor every single year until the bond matures. Because the U.S. government guarantees these fixed payouts, U.S. Treasury bonds are considered the safest foundational investment on the planet, anchoring global financial trust. While that coupon percentage is locked for the life of the bond, the actual price of the bond fluctuates constantly once it begins trading on the open market. This creates the yield. The yield is the actual return an investor receives, which changes based on the specific price they paid to acquire the bond. There is a rigid mathematical relationship at play here. When the market price of a bond falls, its yield rises. If investors drive the price of the bond up, the yield falls. When news headlines report on rising interest rates, they're describing this exact mechanic. Bond yields are going up because global investors are selling those bonds and driving their market price down. This process begins in the primary market, where the Treasury holds scheduled auctions to sell new bonds and set an initial benchmark yield. After that, the bonds move to the secondary market, where global investors constantly buy and sell these existing loans from one another. In this secondary market, buyers are constantly forecasting future inflation and growth to determine exactly what yield they should demand for their money. Ultimately, global market interest rates are simply the aggregate yield currently demanded by human investors trading in this secondary market. When those market rates rise, the cost for the government to borrow new money increases immediately. The consequences are massive. The U.S. government currently pays roughly $3 billion every single day just to cover the interest on its existing debt. To keep up, the government relies on rolling over the debt, a strategy of issuing new, short-term treasury bills to pay off old loans as they mature. As this debt burden consumes more of the GDP, funding for critical physical infrastructure begins to evaporate. It limits the budget available for military defense, and it strains the funding for public social services and healthcare. To pay for these services while managing daily interest payments, the government takes on even more debt, which compounds the crisis for the future. This debt trap directly influences the stock market. Because government bonds are guaranteed, their interest rate is the baseline for all finance, the risk-free rate. Stocks are inherently riskier. A stock represents ownership in a company that can lose value or go bankrupt at any time. This chart shows the equity risk premium, the extra return investors demand for choosing risky stocks over safe government bonds. When bond yields rise, that premium shrinks. Safe bonds become more attractive, causing a sell-off of stocks in favor of guaranteed returns. The bond market actively regulates the economy. By setting the ultimate cost of money, it shapes every business, job, and investment on Earth.